Welcome back to In Your Money. We're discussing investments this evening. My guest, Henry Biddlecombe. And if you'd like to email me, my details will appear on the screen. Henry, before we went off, I said, advocating investing in South Africa, talking about the rand, had a good run overseas, not sure where markets are going. Would you, if you're overweight in offshore markets, would you be bringing any money back at this level and investing in any of the South African stocks?
So, Bryan, I think that was a more obvious trade in the beginning of this year when the rand was quite weak and our equity market was quite cheap. So we were certainly encouraging clients who are underweight South Africa to consider bringing some money back and buying South African equities. I think that trade is mostly done now. So I certainly wouldn't be encouraging it now. What I would be encouraging, though, is looking at bonds again, both locally and offshore. In South Africa, you're earning yields in the region of 10% while taking very little risk. And in the US, long duration bonds are starting to look reasonably attractive, I think, in the mid fours. So don't worry too much. Adopt a balanced approach to your geographical equity exposure. But I think have a look at rotating out of equities into bonds now. I think it's a good time.
Okay. Well, let's get on to the email. Jack in Durbanville says, is inflation behind us, or likely that inflation could increase and interest rates not only reduce, but actually go up again?
I mean, that's a great question. That's the kind of question I'm asking the guys in our investment meetings. What do you think the risk is that central banks now not only need to pause cuts, but re-hike? That would be a pretty big shock for the equity market. And there's a non-zero chance that happens. Certainly not my base case. I don't want to sound like an alarmist, but that's a really good question. Is inflation rearing its head again? Well, you bet your bottom dollar it is. And that's the million-dollar question.
Henry, is it rearing its head in a particular time? Because if I look at the oil price, if I look at the strength of the dollar, I mean, if you think about dollar improving, oil price pretty around the 73, Americans are buying petrol a lot cheaper. So where is this inflation? Where is the inflation occurring? Is it wage inflation? Is it consumer demand? What is it?
I mean, wages for sure. That's been the pressure point for some time. But it's not so much about what's been confirmed already through the data. It's about what's anticipated, given the incoming administration in the US, the subsequent changes in policy, and the impact that those changes will have on inflation. I mean, you spoke about tariffs earlier on, for example. I think that's a good example.
Henry, everything I've read about the election, how wrong everyone got it, but everything I've read is one of the main reasons that Kamala Harris didn't get in, because the Biden administration, middle-class Americans and lower-income people actually struggled with inflation. And if Trump knows, and one of the good reasons, maybe it wasn't support for Trump, it was maybe negative against the Democrats. And that's my reading, but obviously, everyone's got a different view. But I'm asking, Trump would know that imposing tariffs, because American companies are not yet ready to manufacture and do everything that they need to do to pick up the slack that they may be costing China to import into America. He's aware that this is inflationary. Why would he risk the possibility of interest rates not coming down because of his policies?
Yeah, so I think to answer your question specifically, a lot of strategists are saying exactly what you're saying. There's actually a reduced scope for Scump to implement the policy that's been such a big part of his campaign. And perhaps we see a watered down version of the tariff program, for example. So yeah, I think he's under pressure there. And I think that's perhaps why he's making such a big fuss about efficiencies on a fiscal level. He's bringing Elon Musk in. He's jokingly called that department the Department of Government Efficiency, alluding to his Dogecoin jokes that he always makes. But there's a very real purpose to that department, and that's to strip out all of the unnecessary spending at a fiscal level, which is also driving inflation. So I'm sure he's hoping to achieve some kind of balance where tariffs will obviously be inflation positive, but perhaps increasing fiscal efficiency will be a reasonable offset.
Henry, you mentioned the words Dodge, what did you say, Dodge?
Doge or Doge, I'm never sure how to pronounce it.
Because, if I look at cryptocurrencies, we talked about Bitcoin, but Dogecoin is up nearly 3 to 4 times in the last 2 months. Yeah. Is that anything to do with the comment you just made about Trump?
Oh, I mean, it's
Or just
Elon has for a long time always kind of picked up on the Doge trend or the Doge trend. Whether or not he's involved in that cryptocurrency, I don't know, but I think he almost pumps it for fun. He's really popular online. But yeah, so it's a direct consequence of his play on words with the Department of Government Efficiency. And that's what the crypto market is, right? It's a craze, and the stronger the craze, the stronger the price action.
Well, we'll see what happens with his relationship with Trump, with Musk, because one thing we've learned about Trump, you don't do things his way, you fall out of favor. But Peter in Randburg asks, what will happen to companies who are not spending money on AI? Will they be identified as lagging the markets in the years ahead?
Yeah, so I mean, look, I'm certainly not the expert on AI. Spending on AI is one thing, but understanding the impact of AI on your business, I think, is the more important aspect. If I look at my own work, I'm looking at it very closely. I don't think as a business you necessarily need to spend on it. I think there's the massive capex trend globally, mostly by tech companies, I guess, because they have to. They need the processing capacity to be able to deliver those services. But if you're not an IT business and you don't need to process AI, you're going to get it on your IT bill anyway. What's probably more important is to understand what it means for the competitiveness and the processes of your business. Is it going to free up time?
Okay, Henry, I don't know if I lost you there. Are you back?
Probably a combination of both.
Okay.
Yes, I'm back.
Okay, I've got an email from Shelley in Parktown North. She says, it's reasonable to assume that the impact of expected rate cuts will take time to filter through to the real economy. Which sectors have yet to benefit from South African rate cuts, given that companies like Discovery, Mr. Price and others seem to have surged ahead and may no longer offer the same value they did 6 months ago? You made the comment about First Rand, which traded for so long around the 55 to 65 and then after the election up to 80. So the question that Shelley is asking, which sectors? I mean, because we've seen Discovery run from 105 to 190. We've seen Mr. Price nearly touching 300 from 150. So I'm just asking you, are there any particular sectors that South Africa should be looking at that has not yet had that major run with what's happened?
So yeah, firstly, I think the stocks that you've mentioned, I mean, they've enjoyed a hell of a run, and I think it has very little to do with the trajectory of interest rates. That was mostly on the back of vastly improved sentiment, investor sentiment towards South Africa and South Africa's equity market on the back of the election outcome earlier this year. So where is there value in the South African equity market? I think there's still a bit of value in the small and mid-cap space. But again, it's not much to do with interest rates. It's just where liquidity lies. A lot of foreign money looks for the big names that are easy to buy, and it flies straight past the smaller names, which typically have more South African shareholders than foreign shareholders. So look in the small to mid cap space. There's some names that we like there.
Just understanding that small and mid cap, easy to sometimes get in, sometimes very difficult to get out because of liquidity constraints. Okay. One needs to always understand that. And then I've got an email from Leon, but I've dealt with that, Leon, in Hout Bay, in the terms of him being a director, everyone patting each other on the back, well done, and the market doesn't like it. Can really be very, very difficult. Paula in Mshlanga asks, he says, are there global efforts underway to curb the growth of the dominant companies within the cause, which he called the Magnificent Seven or even the top 10? I mean, there's a lot of talk about these companies getting too big.
Yeah, so I mean, I think what the Bureau is alluding to there is anti-competitive behavior. And certainly, the Big Seven are all guilty of it to some degree. And the various regulatory bodies in Europe and the US, more so in Europe, I guess, are taking a dim view of it. Look, I mean, regulation in the tech space is an important function of government, because ultimately these companies do get to a size and a scale where they can start to abuse their strength. They go from being drivers of innovation and growth to inhibitors of innovation and growth to protect their own competitive position. I think a lot of work has been done, and a lot of work still needs to be done. And ironically, from an investor's perspective, often that results in value creation, not value destruction. So,
Yeah.
I still like those stocks, by the way.
Okay, well, Henry, we're coming to the end of our emails, and I always have to try and rush as many. I've got an email on the screen, but I'm going to read one that came in. What would need to happen in South Africa for foreign investors to increase their exposure to South African equities and purchase our bonds? And I think very much about the rating agencies who've made some good noises, grey listing that we may get out of June next year. Would that then get foreign investors to be buying our equities and bonds again?
So if you'd asked me that question at the beginning of the year, I would have said a positive outcome in the election. We've had that. Now, from this point onward, well, we need economic growth. We need companies to grow their earnings. We need continued stability in the GNU.
And Henry, what about GDP, and and most important, what about employment? Surely those are big factors, or are those not factors that influence investors to buy into our markets and also our bonds?
No, well, of course they are. Look, I mean, it's let's park bonds for 1 second. So the two driving factors that you've mentioned ultimately influence corporate earnings growth, and that's what investors are looking at. So, in stark contrast to the US market, I don't think that earnings growth expectations in South Africa are above average. I think they're still fairly benign. So to the extent that companies do start to grow, that there's sequential improvement over the next 2 or 3 years in South African corporate earnings, our equity market could do quite well. In terms of bonds, I think, again, government stability is key, fiscal prudence is key. And based on the things that we watch, we're relatively optimistic there.
Well, it's a pity we always run out of time, but Henry, thank you for joining me this evening. It's important to note that our program is to provide information and should not be construed as advice. Next week's program, we'll be once again dealing with estate planning, and if you need to get hold of me, my details will appear on the screen. I'd like to thank you for watching, and good night.